Hello and welcome back to the course. In front of you I have the Australian dollar US dollar weekly chart. I have the MACD, the moving average convergence divergence indicator, which is an oscillator. And for the purposes of this discussion, I will keep it simple. An oscillator is essentially a momentum gauging indicator. And in the case of the MACD, I often use the histogram, the lines here as the indicator. I don't bother with the signal. There are a multitude of systems that use the signal, but I use the momentum indication itself of the histogram, which is essentially the average between two moving averages. So having said that, as it climbs, you supposedly have more upward momentum. As it falls, you have more downward momentum. But divergence is a state in which the price is not necessarily moving in line with momentum. And we have a perfect example of this on this chart. You can see that price had been falling. And keep in mind, again, this is the weekly time frame. So there's a lot of information in each one of these bars or candles. But at the same time, momentum was going to the upside. It was slowing down its descent. And this is quite often a sign that we are starting to run into a bit of lack of momentum. And in this case, a lack of selling, or at least selling pressure. And typically what will happen is when you get a divergence like this, eventually you break out to the other direction. And that's exactly what's happened. And again, this is the better part of a year, almost 2 years, that you could have taken this divergence signal and made pretty healthy profits. By doing so, you get an idea of when the market is not necessarily telling the truth based upon price itself, because at that point, the best way to look at it is who is left to sell to. You know, we have who's left to start selling this market. We have seen the end of the downward pressure, and that does signify that perhaps we're ready to change the trend. Now, divergence in and of itself can be traded. The problem with it, though, of course, is you don't really know when it's going to turn around in your favor. So quite often, we'll look at divergence as a secondary indicator. The higher the time frame, of course, the more important it becomes, because it takes more trading and more information. And of course, it works in both ways. So this could have just as easily been the price going up, momentum going down. The whole idea is you want to see momentum and price going in two different directions. You can use oscillators for this. MACD is one of the most common, but you can also use the RSI, the CCI, and sometimes even the stochastic oscillator, although I don't like that one so much because it's more of a range-bound type of momentum indicator. So RSI, CCI, MACD, by far the most common ones. The standard settings, you don't need to get cute with it. Use the histogram in the MACD, the RSI, and the CCI, of course, they have moving averages that go back and forth. What you're looking for is a divergence of momentum and price, and quite often that is a sign that the trend is ending and you're about to swing in the opposite direction. And remember, like with all things that I talk about here, the higher the time frame, the more reliable the signal